Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden inside corporate filings, and today we're diving into something a bit different, a new fund gearing up to launch, the Gabelli Preferred and Income Trust. Let's see what its roadmap looks like before it even hits the road. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down these reports further and discuss them. Alright, so what we have here is a brand new investment company, basically a trust that was formed in Delaware. It's planning to be a closed-end fund that invests primarily in preferred securities, aiming for current income with a secondary goal of capital appreciation. Think of preferred securities as a kind of middle ground between regular bonds, which pay fixed interest, and common stocks, which are the regular shares of a company. Now, let's get to the nitty-gritty. What does it cost to be a shareholder here? They've laid out their estimated annual operating expenses. Total annual operating expenses are estimated at 1.63% of net assets. But when you add in the dividends they plan to pay on preferred shares, which they estimated at 120%, the total annual expenses clock in at a rather significant 2.83%. To put that into perspective, they give an example. If you invest $1,000 and it grows by 5% each year, you'd be looking at paying around $29 in expenses in the first year, 88 ALs over 3 years, and a hefty 316s over 10 years. Ouch. That's a substantial chunk of your returns going to fees and expenses. Their main investment goal is current income, and they plan to put at least 80% of their assets into preferred securities. This is pretty straightforward, but it also means they're heavily concentrated in one type of investment. And speaking of risks, this is where they really lay it all out. We're talking about a whole range of things that could go wrong. There's general market risk, meaning if the whole stock market goes down, this fund likely will too. Interest rate risk is a big one for income-focused funds like this, as rising rates can hurt the value of their existing holdings. They also dive deep into the specific risks of preferred stocks, like the possibility of dividends being deferred or not paid, and how preferred stock is usually lower in priority than a company's debt if things go belly up. They mention preferences like deferral, where the issuer can put off paying dividends, which means the fund might have to report income it hasn't actually received yet. They also talk about non-cumulative dividends, where the issuer doesn't have to make up for missed payments, which could really hurt the fund's income stream. And then there's subordination. Preferred stocks are lower down the line than bonds. There's also good old equity risk, which is just the general risk that stocks they own might lose value. Common stock risk is similar. If a company they invest in stumbles, their common stock price can tank. Convertible securities risk is also mentioned. They're a bit more complex, as you might expect. A key strategy here seems to be investing in what they call non-investment grade securities, or junk bonds as they're commonly known. They say they can invest up to 10% of their assets in these. These are riskier because they're issued by companies with lower credit ratings. The upside is potentially higher yields, but the downside is a much higher chance of default. They highlight that these are speculative and have major risk exposure. They plan to use leverage, which means borrowing money to invest more. This is a double-edged sword. It can boost returns when things go well, but magnify losses when they go badly. They mention issuing preferred shares as a way to leverage, and they explain how this can make the net asset value of their common shares much more volatile. For instance, they've provided a table showing how a hypothetical 5% drop in their portfolio's return could translate into a more than 7% drop for common shareholders when they use leverage. It's this leverage that really amplifies both the good and the bad. They also acknowledge the impact of government actions and regulatory changes. Changes in laws or new regulations could affect how the fund operates or even its ability to achieve its goals. A more technical but increasingly important point is SOFR risk. LIBOR, a benchmark interest rate, is being phased out. They're transitioning to SOFR, the secured overnight financing rate. But SOFR is pretty new and volatile, and there's no guarantee it will behave like LIBOR did, which could mess with how their investments are valued and managed. The Board of Trustees is made up of 13 individuals, a mix of interested and independent trustees. Mario J. Gabelli, a big name in the investment world, serves as Chairman and Chief Investment Officer. He's also involved with Gumso Investors, Inc., which manages a boatload of money. It's worth noting that many of these trustees have extensive backgrounds in finance, law, and business, which is good for oversight. Looking at who owns what, it's interesting to see the dollar range of equity securities held by the trustees. Most of them, including Mr. Gabelli and several independent trustees, hold no direct equity in this specific fund yet, which makes sense as it's just launching. However, many of them hold significant amounts in the broader family of investment companies, which tells you they're invested in the overall Gabelli operation. Daniel M. Miller is the portfolio manager. He's been with the firm since 2002. The report talks about his compensation structure, which includes a base salary, stock awards, and performance-based pay, tied to the fund's net revenue. They aim to reward good long-term performance, but it's not directly tied to specific benchmarks for any single account, which can sometimes lead to potential conflicts if managers are incentivized to favor certain accounts over others. They also detail how they handle brokerage. They can use affiliated brokers like G Research LLC, which simplifies things but raises questions about whether they're always getting the absolute best commission rates. The idea is they'll get competitive rates, but they don't commit to always paying the lowest. This section gets into the weeds on taxes for both the fund and its shareholders. The fund aims to be a registered investment company, or RES, which generally means it avoids paying corporate taxes if it distributes most of its income and gains, but there are strict rules they have to follow, and failing to do so could mean paying corporate taxes, which would hit shareholder returns hard. For shareholders, distributions are generally taxable, and there are special rules for qualified dividends and capital gains, plus potential taxes on foreign income. They have clauses in their governing documents and advisory agreements that indemnify their trustees and officers. Essentially, they'll protect these individuals from liabilities and expenses, as long as they haven't acted with willful misfeasance, bad faith, gross negligence, or reckless disregard. This is pretty standard for protecting leadership from lawsuits. Now, looking at these numbers and what they mean more broadly, the Gabelli Preferred and Income Trust is entering a market with a clear strategy. Focus on preferred securities for income. However, their estimated total expenses, especially when including preferred dividends, are on the higher side at nearly 3%. This is a significant hurdle to overcome before shareholders even see a return. The heavy reliance on preferred securities also means their performance will be closely tied to the health of that specific market segment. The use of leverage, while potentially boosting returns, is a major risk amplifier here, directly impacting common shareholders with greater volatility. Plus, the fund is navigating the complexities of new benchmark rates like SOFR, which adds another layer of uncertainty. On the upside, they have seasoned management with extensive experience within the Gabelli Group, and the board has a good mix of independent and interested trustees who seem to have a broad range of expertise. However, the inherent risks of their chosen investment strategy, coupled with high costs and leverage, make this a fund for investors who are comfortable with a higher risk profile and who understand that those fees eat into returns over time. They're aiming for income, but it's going to come with a significant risk premium. Alright, that's our breakdown of the Gabelli Preferred and Income Trust filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.